So there are many uses of options, and one of them being as far as used as a hedge against your other positions. Options traders can bet or hedge against their spot holdings by buying put options on them. If their main holdings go down in value, the put options can help mitigate losses. For example, let's imagine if Drew bought 100 Bitcoin at $50,000 per coin. In case the market starts to turn downwards, Drew could buy put options with a strike price of 48,000, and he could, in this particular case, pay a premium of $2,000 per share. Now, if the market turns bearish and Bitcoin falls to, let's say, 35K, then Drew can then exercise the contract to mitigate losses by selling each contract for 48,000 instead of 35,000. Now, if the market turns bullish, he doesn't need to exercise the contract, and he only loses the premium paid. But in this case, if the market turns bullish, he still has 100 Bitcoin at $50,000 each, so he's winning on both sides. It's also used in moments of speculation. Options are often used in speculative trading. Traders that expect an asset to go up can buy a call option. Now, if the price moves above the strike price, then the trader can then exercise the contract and buy it at a discount. When the asset's price is above or below the strike price in a way that makes it profitable, the option is said to be in the money. Contracts that are at the money are at its break-even point, and they are considered out of the money if they are at a loss. So there's some basic options trading strategies, and they can differ depending on whether the trader is buying call options, which is the right to buy, buying put options, which is the right to sell. If they're writing call options, which is selling to the buyer of call options, and if they're writing put options, which is when they are buying from the buyer of put options. One of the possible strategies is the idea of having protective puts. This involves buying a put option contract that is already owned. This is the hedging example used above and is known as portfolio insurance, as it protects the investor from potential downtrends. There's also the covered call. This is when the trader sells a call option of an asset that is already owned to generate more income, which they're getting from the options premium from their holdings. If the contract is not exercised, they keep the premium along with their assets. But if the contract is exercised due to an increase in the price of the market, then they are obligated to sell their positions. There's also straddling. This is when the trader buys a call and a put on the same asset with identical strike prices and expiration dates. In this particular case, the trader is able to profit as long as the asset moves far enough in either direction, up or down, and this is considered a bet on market volatility. Basically, you have both a call and a put, a long and a short in both directions, and depending on the general movement, you're looking to capitalize on market volatility. If it swings down and then swings back up above that entry price, then you could capitalize on your put and then capitalize on your call position as well. There's also strangling. This is a situation where the trader buys both a call and a put that are out of the money, which is a strike price above the market price for call options and below for put options. Essentially, the positions are not in profit. They are underwater, so to speak. It is similar to a straddle, but has lower costs for establishing a position since both are out of the money. It requires a higher level of market volatility to be profitable. This one in particular is um, even considered a higher risk compared to all of them. I mean, even just options trading in general is considered fairly risky, but strangling is definitely a risky strategy, considering that you're buying positions, you're taking over positions that are not in profit, they're at negative, they're at a loss, and you're hoping because you're hoping to enter in those positions, and you can do so because they have lower cost for establishing the position, lower premiums, lower cost of entry, because they're already at a loss. You're looking to take in those because you're expecting some sort of reversal that you can capitalize on. There's a lot more inherent risk, and even entering in that can be a very situational choice to make. Brief rundown of the advantages of options: good for hedging against market risk, flexibility when trading based on speculation. There's possibilities for multiple combinations and trading strategies. They're profitable, potentially, in all markets, bull, bear, and sideways markets. They can be used for lowering costs when entering positions. And multiple trades can be initiated at the same time. As far as disadvantages, there is a barrier to entry. They're harder to understand, even harder than comparing them to futures contracts. Many calculations are necessary. Many different parts and terminologies are used. It's generally considered high risk, especially for contract writers, because you are more obligated to fulfill your end of the contract depending on when the buyer of the contract exercises their option. This is often more complex trading strategies are implemented when compared to spot and other trading markets. This is definitely a much more complex trading strategy, and even compared to futures markets, the idea of having that relationship between the contract writer and the contract buyer. There can also be lower levels of liquidity, which could be a cause for concern. Perhaps there's issues getting your contracts filled or finding buyers of the contracts or writers of the contracts, depending on the time, the location, and the platform or exchange. It's also important to consider that the premium value of contracts can be volatile and usually decrease as the expiration date approaches. Now, if we were to compare the two, they are both derivative instruments, options and futures, but settlement is different between the two. And this is really where one of the main differences between options trading and futures trading come into play. In a futures contract, the contract is always executed when the expiration date is reached. Contract holders are legally obligated to exchange the underlying asset or cash equivalent. Options contracts, on the other hand, are different in that they are only exercised at the discretion of the contract holder, which is the buyer. If the contract holder exercises that option, the contract writer, this is the seller, is obligated to buy or sell the underlying asset depending on if it was a call or a put. The contract writer is obligated to fulfill their end of the bargain depending on when the contract holder, the person buying the contract, exercises the option.